Pfizer Inc. ticker symbol PFE is currently trading at $26.86 a share. Over the last year, it is down about 8.64%. And if we go over the last 5 years, it's even down 28%. Since its peak at the back end of 2022, after it had a strong run due to a certain product that was very popular, the stock is now down about 54% from those highs. So what we're going to be doing is seeing if it is the right time to buy. We're going to look at the company's financials using my automated stock valuation spreadsheet, then see if it's a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. So if I put in the ticker PFE, this will load all the latest company financial data. If you're interested, check my Patreon, but let's look at the numbers first. $26.86 is the price, 152 billion in market cap, a P ratio of 36.3, which is higher than the market average, which is 30.2. Earnings per share 74 cents and a beta of 0.64, meaning it's less volatile than the market. Analysts do currently say it is a buy though, $31.78 a share. Let's see if we agree with that when we look at the models. They do pay a very nice dividend. You can see here 6.4%. It's quite a lot, meaning you will get around, well, you won't get around about, you'll get exactly $1.72 per share. And if you want to get paid the dividend, buy before the 21st of January, as that is the ex-dividend date. But looking here, it is not currently a very safe dividend. 9.7 billion, higher than the net income and higher than the free cash flow payout ratio. So about 200% respectively. You can see here the net income and the free cash flow. These are down quite a bit, but let's have a deeper look first. So revenue wise, 60.11 billion. Up from the prior year, yes, but not as high as all times. You can see, as well, as I said before, YouTube will don't like it when I say a certain word, but we all know what happened in these years, and you can see the revenue spiked accordingly. But if we do take out that revenue, you can see it's been relatively flat. So the price is down from where it is. If we go to a slightly larger chart, we can see that the price is pretty much back to what it was in, well, you can see around about the start of 2020, March of 2020. Well, that was almost the day of when a certain thing happened. Quite interesting. But obviously, apart from these 2 years, revenue is up slightly from where it is, but down massively from these two. Net income, are they able to generate as much profit? Currently 4.25 billion, up from the prior year once again, but down from these all-time years here, and realistically lower than what it has historically been as well. So that is a bit of a negative. Free cash flow down as well, 4.03. Repeating myself over and over again, but down from the two prior years, and also down from the non-COVID years, we'll say. Are they able to generate more operating cash flow minus the capex? Where you can see even operating cash flow is down here, but in the trailing 12 months it is up from the prior year, so that is trending in the right direction. Shares outstanding, what are they doing? Well, they did historically buy back shares, but you can see share count has increased slightly, so hopefully they're using that to invest back into the business. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them in today's value. And let's see what it says. So currently, we'll decrease the weighted average cost of capital. It is quite low, but it's we'll do 8.5. Currently at $132 a share. So let's have a look at these numbers and see if we actually agree with them, because these are based on averages. Initially, we are expecting revenues of 60, and well, you can see very slowly declining revenues. Do analysts agree with us? Analysts actually expecting very small increases in revenue, so we'll increase that just a little bit. We'll do 1.5, $138. Net income margins, I see they're all over the place here. Oh, sorry, I didn't click 1.5 there. 140. Net income margins, I mean, we'll look at two numbers here, because these numbers are sort of more recent. That brings us to about 5%. We'll do 5.35. Still $41 a share. And oh, here we go. This is why the difference is. So this number is really throwing everything out. We take an average of all of these. That brings us to about 81%. $9 a share. 18.2. So if we have If they can keep their margins of what they historically been about 20%, then it is $32 a share. Even with these, and if we even go on the more bullish case, which is the trailing 12 months is more true on the free cash flow, $38 a share. So discounted free cash flow does seem to like the stock, does suggest it's overvalued. Currently, yes, 37 in terms of the free cash flow ratio, but over the last 5 years, about 10. Dividend discount model, I'll just have a quick look here. We'll bring the weighted average cost of capital down to about 8.5. We'll do 8. And if they can keep on, yeah, 8.5 is more fair, but their weighted average cost of capital is actually lower than 6%. But you can see here that we'll go 2.53. So at this discount rate, which is higher than the current weighted average cost of capital, it is slightly undervalued. But obviously, as this number goes down, the intrinsic value increases. So at 6%, it would be $50 a share. So dividend discount model does seem to like the stock as well. Ben Graham formula for intrinsic value. This is the method of valuing stocks created by the godfather investing himself, Ben Graham. It looks at earnings per share, PE of a non-growth company, and well, quickly here you can see here that over the next year, very small growth, less than 1%. So I won't look at this. $5 a share. Ben Graham does not like the stock. And let's finally look at the comparable company model. This way of valuing stocks, looking at competitors of similar industries and similar sizes. What we can do here is look at the revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book PEG, Peter Lynch's price to earnings growth, and then the metrics that we're looking at specifically in the model is EV to revenue, EV to EBITDA, PE, and forward PE. So some companies that I think are similar. J&J, they're one of the healthcare giants, pharmaceuticals, medical devices, consumer health. And if you put in the ticker here, it'll load all the company financials for these similars. We'll do Merck. We did them the other day. Merck & Co. Oncology and vaccines. And finally, we'll do the Lilly and Company. See what this gives. If you're interested in the sheet, check my Patreon. It's the $4 tier for the spreadsheet. Gives you full access to all the sheet and the data. You can have your own copy of it, and you can do these reviews as you please. If you want me to continue doing reviews for you personally, then it's the $7 a month tier. Or if you just want to help me out, $1.50 will very appreciate it. But enough of the hard sell. So we have the three competitors. Enterprise value, Pfizer is actually the smallest. Revenue, second, well, almost in the middle of the park here. Much higher than Lilly, smaller than J&J, and about the same as Merck. So that's quite interesting. Revenue growth rate, second highest. Sorry, I missed that one. I thought it was a 1. Second lowest, higher than J&J, but lower than the other two. EBITDA, third highest again. Net income, least profitable. Smallest margins by quite a bit, 7, 16, 19, and 20. So price to sales, lower than the market average, which is about 3, and actually the lowest here. Price to book as well, lowest. Market average is 5.2, lower than all these. And PEG, which is Peter Lynch's price to earnings growth. Ideally you want this under 1. They're all under 1, but 0.2, so that's pretty good as well. So EV to revenue, lowest. EV to EBITDA, middle of the park. PE, yeah, so gives us average about 57, but I really think this company is throwing everyone off. So I'll just switch them for AbbVie, see what they give us. There, once again, oncology and immunology, Humira, I believe, one of the world's best-selling drugs. See, now this brings it a bit more down to life, but still a buy at $35. So it does look slightly undervalued compared to its competitors. But yeah, is it worth the risk potentially for a stock that has dropped 50%? That is the question. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already, and I'll catch you guys next time.